Hello and welcome to this week's episode of Damien's Midweek Markets, the show where I talk about what's been happening in investment markets last week and what to look out for in the coming week. Now, those of you who follow me on 80/20 Investor and my portfolio should have received today, or will do, an update to my latest 50k portfolio. And it's been interesting because this week had two potentially big market moving events. So we had Brexit, or the latest saga of whether we'd get an extension on Wednesday, and we also had the release of the US Federal Reserve's meeting minutes from March. Now, if I deal with Brexit first, then we actually got the extension that we were expected, and it's for 6 months. And we're going to have all the usual rubbish headlines about Halloween and how scary Brexit is, but we can largely just try and ignore those. But what's really important is to have a look at the impact it had on investment markets, and the answer is pretty little. So if you look at the pound versus the dollar exchange rate, we still are around $1.31. It didn't really have much of an impact. That's largely because everybody was pricing in an extension. They didn't really believe that we were 48 hours from a hard Brexit, a no-deal Brexit. But it had the potential to move markets, which is why I delayed making any changes to my portfolio, especially as unit trusts always have you out of the market for a day while any fund switches go through. Then, of course, if we go over the Atlantic to the US Federal Reserve, those meeting minutes gave more detail about what they thought about the economy and the potential future of interest rates. And of course, those two things have moved markets in recent times. Now, the meeting minutes basically said that the Fed could put rates up or down or do nothing. And so the market just took that as they didn't learn anything new, so the market just stayed kind of bouncing along where it is on the S&P 500, and that's up towards the 2,900 level. But what the meeting minutes did show is there was a rising concern among the members of the Federal Reserve about the yield curve. Now, I've talked about the yield curve on previous shows and how it can be an indicator of an impending recession in the future. Now, that obviously caused a little bit of angst amongst equity investors. It saw the bond market gain strength, the yields fell a bit, but generally speaking, there wasn't any huge market movements, and we're still where we were a couple of days ago after a pretty decent rally on equity markets. Now, if we look at individual indices, let's go with the S&P 500. We're up near that 2,900 level, like I mentioned, and we've been bubbling along, trying to break above it, pulling back ever so slightly, but not anything particularly serious, and we're still trying to break above that level. Now, if you look at the S&P 500 over the last 6 months, particularly year to date, you see that the year to date there's been a nice rally, but in recent weeks that rally isn't quite as vertical as it was. It's slightly leaned over, but it's still moving upwards with an odd pullback. If you draw a line, so a resistance line above the highs and a support line below those rising lows, what you see is a rising wedge, and it means that the S&P 500 is getting forced into a corner where it has to decide whether to break higher or break lower. So it's kind of like a day of reckoning. So it will be interesting to see what will happen in the coming weeks and days on S&P 500. If we break higher, then that could mean new all-time highs. If we break lower, then I think the markets will get really spooked if we go below 2,790, as that will be a bit of a floor at the market at the moment. Now, if we go to the FTSE 100, we're heading towards that 7,500 level that I've mentioned in the past. We made some good headway from 7,250 up to 7,500, and it's a good area to keep an eye on. But in last week's show, I mentioned about sectors and about the importance of sectors, especially in a market like the S&P 500, where we're in a bit of a muddle, a bit of a mess, and we're going probably sideways rather than up or down. Individual sectors can show a general move. If more sectors within the index start to join the uptrend, it could be a sign that the overall index will go higher. Equally, if they were to all start breaking lower, it can give you a sign that the index will break lower. Now, for 80/20 investor members, I'm going to do a bit more about that this week, more than likely in the newsletter, because I'm conscious of them in my update of my 50k portfolio. So those of you who receive that will see some of the reasons why I picked the funds that I have based on some of the individual sector performances. But it's not just about sectors, because sometimes it can be about countries as well, which can give you a bit of a steer of whether the market might go higher. Now, the S&P 500 and the German DAX have historically had quite a tight correlation in terms of when one's moved higher, the other has as well. But at the end of 2018, that correlation started to break down. It started to diverge. So we had new highs in the S&P 500 in September, but the DAX continued to drop lower. Now, at some point, it would make sense that that divergence would snap back together, so they start to become correlated. Either the DAX would suddenly rally or the S&P 500 would suddenly tumble, so it would underperform. So the DAX hasn't necessarily outperformed the S&P 500, but if the S&P 500 is to continue higher, it makes sense that the DAX will continue to break higher and break through a very key level of resistance that it's butting up against, which I identified that for 80/20 investor members in this week's newsletter. So in the coming weeks and days, keep an eye on the DAX. If we see that burst higher, then we suggest that European equities will start to pick up. And with the correlation, historic correlation between the DAX and the S&P 500, it would just give a little bit extra weight to the bullish argument for investing in equities right now. Of course, if it broke lower, then it would be the opposite. Now, if you look around, there's hardly any fear in the market. The VIX, that fear index I talk about, is way down at 13. So it's either a lack of fear or complete complacency. Now, one thing to look out for going forward is this Friday is the start of US earnings seasons. That means that US companies start revealing and reporting their profits and earnings. Now, this particular earnings season has got some people a little bit nervous, because it could be the first one we see some sort of contraction in the earnings and profits of companies. So there has been elements of profit taking leading up to it, but don't be surprised if we get some volatility going forward. The last earnings season we had at the first quarter of this year, some analysts were expecting an equity market sell-off. They were expecting the bull rally to collapse because it was going to be dire. In fact, we actually held up pretty well. I think expectations were lowered so much that actually the low bar was met. This earnings season could be different. It might not. So the next couple of weeks are going to be key. So keep an eye on earnings, which start on Friday. Now, that is it for this week. If you want to get in touch, then you can do at Damien@moneytothemasses.com. And of course, you can get me on Twitter at moneytothemasses with the number 2. Hello and welcome to this week's episode of Damien's Midweek. Sorry, I just can't help thinking I've done this once already. Right, okay.